Welcome back to this week's African Grain Overview. Over the past month, we looked at four important themes in the regional grain and oilseed markets. The large maize supply building in southern Africa, the soybean and soy meal opportunity into East Africa, Zambia's soybean position, and then the Zambian wheat market, where imports are currently underway ahead of what could be a record crop. So this week I want to pull all of that together into one bigger picture. Africa currently has grain available, but the market is already starting to look ahead to the next risk, and that is weather. All in this week's African Grain Market Overview, made possible by Collateral Management International and Zimmatic Irrigation Systems. Collateral Management International, or CMI, works across the continent, helping banks and other financiers keep their commodities secure and well managed. With over a decade of experience, they're known for their reliable storage solutions, trusted staff, and professional stock monitoring and inspection services. CMI helps make sure everything runs smoothly and securely. CMI, your trusted collateral manager in Africa. Let's start with maize. The regional maize balance sheet has changed quite sharply over the past two seasons. Last year, the region moved from a small deficit into a much healthier surplus, mainly because of South Africa, Zambia, and Tanzania producing good crops. For the 2026-27 season, that surplus could increase even further, with our current estimate pointing to a regional white maize surplus of around 5.5 million tons after import needs are met. This is big. In fact, if these numbers hold, it could be the largest regional surplus in at least the past decade. South Africa is again expecting a large maize crop. Zambia is also sitting with a large crop, and Tanzania remains an important regional supplier. On paper, this should keep maize prices under pressure in surplus countries, especially where storage space becomes tight and where old stock quality starts becoming a bigger problem. But this is where the story becomes very complicated. A surplus is only useful if the grain is in the right place at the right quality and can be moved into the right markets. There are already concerns about the quality of older maize stock in Zambia and Tanzania, especially where storage facilities are not ideal. If some of that maize becomes unsuitable for food or even feed use, then the real usable surplus could be smaller than the headline number suggests. The second issue is demand. Kenya's import need has been adjusted higher after Contact started reporting drier conditions in parts of the North Rift Valley. If their crop comes in closer to 80% of the normal, it creates more demand for regional maize. But the bigger question remains, where does this large South African surplus go and at what price? Now looking ahead, the biggest risk is El Nino. Weather forecasters are increasingly warning about a strong to potentially very strong El Nino pattern during the second half of 2026 and into early 2027. Historically, El Nino often brings below normal rainfall to southern African countries like South Africa, Zambia, Zimbabwe, Malawi, and even Mozambique. At the same time, northern areas such as Tanzania, Uganda, Rwanda, and Kenya can sometimes receive better rainfall. This means the market is dealing with two opposite forces. For the short term, the region has enough maize. That is price negative. But for the next production season, the weather risk is rising. That is price supportive. If we see a repeat of a season similar to 2024-25, the regional maize surplus could shrink sharply. However, because carrying stocks are currently expected to be large, the region could still avoid a major shortage unless the drought is severe and widespread. So, my view on maize is this: short-term prices in surplus countries can remain under pressure, but I would be careful to become too bearish. The market will possibly start adding a weather risk premium as we move closer to the next planting season. Now let's move to soybeans and soy meal. This is probably the most interesting opportunity in the region at the moment. The Eastern African soybean and soymeal market is currently being supported by one major factor: India. India is a non-GM market and normally imports non-GM soybeans while also exporting soy meal into markets like Tanzania and Kenya, for instance. But India's soybean prices have moved sharply higher over the past year, and Indian soy meal has become expensive compared to Zambia and Malawi origin. That has opened the door for East and Southern African suppliers. Zambia, Malawi, Uganda, and Ethiopia are all non-GM producers, and together they could have an exportable soy meal surplus of around 240,000 tons. On the demand side, Tanzania, Kenya, and Rwanda together could need roughly 370,000 tons of soy meal imports annually. That leaves a potential shortfall of around 130,000 tons if India stays out of the market. That is important because it means Zambian and Malawian soy meal should remain well supported in the short to medium term. Zambia's soybean crop is estimated at around 450,000 tons. With a local crushing capacity of more than 1.2 million tons, most of the crop should be crushed locally. We expect around 400,000 tons to go into the local crushing industry, producing roughly 300,000 tons of soy meal. Zambia's own soy meal requirements is around 220,000 tons, which leaves a potential exportable surplus of about 80,000 tons. That export surplus needs a home, and Tanzania looks like the most natural market for this. Kenya and Rwanda can also take product, but Tanzania is likely the main opportunity in this area. However, there are risks. If Nigeria becomes a more active supplier of non-GM soybean or soy meal into East Africa, it could limit price upside. And if India comes back into the soy meal export market during the first half of 2027, competition will increase again. There is also always policy risk. Zambia may restrict soybean exports to protect local crushers. Malawi requires special permission for formal soybean exports, and Mozambique also wants a local poultry demand covered before exports are allowed. So the soybean story is very bullish, but not risk-free. My view is that soybean and soy meal prices in Zambia and Malawi should remain supported over the short to medium term. Then lastly, Zambian wheat. Zambia is currently in its duty-free wheat import window, which started in April and runs until the end of August. The 2025-26 supply and demand picture suggests Zambia produced around 300,000 tons of wheat, while local consumption is around 300,000 tons. On top of that, Zambia usually exports around 200,000 tons of wheat flour into southern DRC. That creates an import need of around 200,000 tons for the current season. There is talk that about 80,000 to 90,000 tons has already been imported, so the import campaign is well underway. But the new crop outlook is the real story to look out for. The 2026 wheat crop, which could start harvesting from the middle parts of September, looks very promising. Irrigation dam levels are good. Kariba is at its best level since 2017. No load shedding is expected for the rest of the year, and most fertilizers were shipped before the Middle East conflict created more uncertainty. Contacts are talking about a crop of more than 450,000 tons, which would be the largest wheat crop in Zambia's recorded history. If that happens, Zambia's 2026-27 wheat crop import needs could drop sharply to around 50 to 100,000 tons. Price-wise, currently Lusaka wheat prices are around Black Sea import parity levels, close to $460 per ton. But once import duties and surcharges return from 1 September, the landed import parity numbers moves closer to $550 per ton. Historically, Lusaka wheat prices during harvest and just after harvest have also traded around that $550 level. But this year the big crop could cap the market. Some observers believe prices could be closer to $500 per ton during harvest if the crop comes in as expected. So my wheat view is simple. Prices can firm into September as duties return, but the size of the local crop will decide whether the market moves closer to that $550 mark or gets capped near the $500 mark. For deeper insights into the African soft commodity markets, contact Jacques today to access Commodity Insight Africa's full weekly reports. A special thank you to Collateral Management International and Zimmatic Irrigation Systems for making this episode possible. Thanks for joining us, stay informed, trade wisely, and we'll see you again next week.